happy to host this workshop here with the topic of how to successfully raise your next financing round. I assume a little bit of a mix in the audience, maybe some current founders that are in the early stages, maybe also some folks that plan to start their own company soon, but have not done so. So it's a little bit of a mix, and I try to incorporate different viewpoints on it. But of course, it's most tangible for the ones that actually aim to raise their maybe first or second financing round anytime soon. In the meantime, while I go through the slides, please feel free to raise your hand or to type any questions you might have in the chat. It's always more fun and more engaging if it's a conversation rather than just a presentation. And let's try to do it as good as possible in this virtual setting here. All right, let's dive right in. I would start with a brief introduction about our fund, UVC partners, and also a brief introduction to myself, and then quickly move to the actual topic. So I'm Alex. I'm a principal at UVC Partners, and we're a Munich and Berlin-based early-stage fund. We are around for a decade right now, investing out of our third fund generation, an over 200 million euro fund. We invest on the B2B side in the areas of enterprise software, industrial technologies, and mobility. So we do invest in software and in hardware companies, and we do that usually in the early stages, meaning anywhere between pre-seed to Series B. And to make it a little bit more tangible for you, we invested anywhere between pre-product, pre-revenue, up to a couple of million in revenues. That's really the range where we like to engage. Geographic focus is on Europe, like I said, and we typically invest in the first financing round anywhere between €500,000 and 5 million euros. We support our portfolio companies with a broad network of corporates, BMW, Siemens, and the likes, where we have excellent relationships and can help you guys with sales initiatives or any kind of partnerships, biz dev initiatives. And also we actively help our portfolio companies recruit talent. Is it on the second management level then, or maybe in the sales function or engineering function? And we as a team, especially my colleagues, they have invested in the B2B space for over 20 years by now. So I have seen some best practices there when it comes to, for example, not only recruiting, but also sales, how to build up sales processes and other functions within early stage startups. So quickly about myself. So I'm a principal with UVC Partners. I'm with the fund for over 4.5 years by now, and I opened our Berlin office in 2019. So that's just a quick intro to the fund and myself. Before we move to our portfolio, this is a little bit of an overview about the different sectors we are addressing here, and an overview of some of our portfolio companies here as well. Among them, our most recent investment, for example, Aleph Alpha on the AI or enterprise software side. But without further ado, let's move to the actual topic. How to successfully raise your next financing round. And we come to a little bit of a boring topic, but very important topic, actually. That's the preparation. And we have really two different work streams here. One is to get the documents in place you need for raising your round. And the other one is how to strategically also plan the reach out to investors. So let me briefly start with the document part, and then the second step move towards the investor reach out. And again, please jump in anytime if you have questions or want me to clarify something. So obviously, first aspect is the pitch deck, right? And I would always like to encourage the founders to focus on 3 core areas. This is the questions here: why you? So it refers to why you as a team will be successful in tackling that specific problem. And why is your positioning of the company in the overall market landscape or in the competitive landscape the winning approach? Because quite often we see quite a few startups tackling a specific industry, a specific industry sector, and we ask ourselves, what is the winning approach here? Who has the most interesting go-to-market approach? and product offering. And it needs to be crystal clear in the pitch deck. Why is it you as a team with your skill sets, with your prior experience? And on the other side, why is it with the positioning of the company you've chosen? The second is the market opportunity. So why is the market opportunity attractive, meaning large enough for investors to invest? And the last one is why invest now? Especially for multi-stage investors, it's pretty easy to pass on your early rounds, let's say seed or even Series A round, to say, I can also invest in a Series B round. Why should I take the risk now? So you have to create a little bit of a momentum there and show investors also why it's the right time to invest in your company now and not on a later stage. And in addition, also why invest into that specific market segment at that given point in time. Why is there momentum in the market? Why does it make sense to start a company in that market at that given point in time? I'd just like to share a couple of resources here from Y Combinator that have done a pretty good job in giving a little bit more background, what to include in your pitch deck, how to structure it, how to phrase things. I think there are numerous good resources on the web, so I won't dive into that in great detail. But one approach I've seen with our portfolio companies work quite well, maybe at the seed stage or Series A stage and later, is to actually hire a designer to polish the slides. I think it goes a long way in making it more visually appealing to investors, and it just really helps to flush out a few design bugs, so to say. So it can be money well spent actually, and it pays off in the fundraising process. The second aspect is the financial plan. Obviously, the financial plan should support your growth ambitions and show what you want to achieve. So aiming high, but still being realistic here. And the next aspect is investors really want to see that you understand the drivers of the business. So what drives both the revenue side and also the cost side. And if those assumptions are unrealistic or it's pretty unclear how you want to achieve the ambitious numbers you put in the pitch deck, then it's a little bit of the question: does the team really understand what they're aiming for? And the last aspect here, I would like to mention the financial plan. Obviously, we want to understand, is the money spent on, let's say, paid social, or is it spent on engineering efforts over the next 12 to 18 months? So what is the team using the funding for? Last aspect is a data room, and that depends a little bit on your stage. So if you're very early, let's say pre-seed, for example, you probably don't need that at this stage, especially early in the process. But if you're a more established startup that has raised another round before, it's usually pretty helpful to say or to signal to the investors at least that you have a data room, that it's fully prepared. And it just shows to investors that, yeah, you're ready to engage in the process, and that even other investors might have asked for it, right? Which could signal to investors that it's a competitive round and that they are not the first one engaging with you. So that creates momentum on your side if you show the preparedness and that you have it ready. Moving on to the next part, investor selection and outreach. It sounds pretty easy, but I'm quite often surprised that founders don't put more preparation into it, because I think it's a very crucial step to understand the investor side better, and just it makes the process way more efficient. So investor long list. Usually you will create a long list of investors that could be suitable for your business, and then you narrow it down, given a few criteria, to just a short list of investors that you will eventually actually reach out to. And in order to narrow that list down, I would focus on the following. Is this investor investing in hardware and or software companies? So specifically, if you're a hardware company, has this investor invested in hardware startups in the past or not? So usually you can seed out quite a few funds there already. Is the investor relevant for my current stage? So am I too early maybe for this investor? Am I too late? Also, there's a huge differentiation in the market. And then geography. Is this investor actually investing, if you're based in Germany, is this investor investing in the German ecosystem or not? So that it just increases your likelihood if you check this criteria. And then also an important aspect is to see whether there's a portfolio conflict, right? So some investors might have invested in a competitor of yours or in a very close solution. So you wouldn't consider it a competitor right now, but maybe if you develop your product further, add different functionalities, it might be a competitive situation in 1 or 2 or 3 years down the line. And VCs usually try to avoid that for good reason. So a good rule of thumb when qualifying your investors is to ask yourself, has this investor invested in similar companies in the past? And obviously not in competitors, but in similar business models, similar markets, similar technologies maybe. So that makes it more likely that the investor will also engage with you. And if in doubt, just ask other founders about their experience, about their assessment of other VCs. Ask business angels. They usually have quite a few relations. And also maybe ask other VCs if you have good relationships with them. And here resources, Crunchbase is an excellent resource and quite cheap to get an investor list to see their portfolio companies. There are also quite some good web researches or websites where they list different investors for different fields. And there's this European investor list, which I saw that there is a question. I hope that I will be able to share this presentation with you in some type of form so that you should have access to all the links here and also to the content. I'm not quite sure it will be possible, but I will ask. So hope that answers your question, Thomas. Investor outreach. So start reaching out to investors well before you need the money in the bank, as the process usually takes time and it's really hard to foresee how long it will actually take. And always, I mean, that's common sense, right? Aim for warm introductions from business angels or portfolio founders of the respective VC or from other VCs. And next advice would be contact the investor in batches. So if you reach out to 50 investors at the same time, it can be quite cumbersome to balance the process and to handle all those different streams of communication. So try to batch them, makes it way easier for you to handle the workload. And maybe you start with a few test pitches before you reach out to your preferred investor of choice. So you can hone in on the pitch, get a little bit of a practice in, and can refine the pitch given the feedback of the first investors. And then you, in the second round, you address the investors you actually want to get on board with, preferably. And also look at when you're targeting VC funds, look at the respective individual investor at this firm. So meaning, is this a good industry fit of what this person has invested in the past, or is it more of a stretch? And there you can increase the likelihood by reaching out to a specific person at the fund that your fundraising process will be successful. And yeah, I would highly encourage also to track the status of those investor discussions in the spreadsheet, as it becomes, yeah, like I said, quite cumbersome if you have 50 plus conversations at the same time, and then to remember what's the current status with each of them. Right, up to the next one, how to achieve an efficient fundraising process and how to assess investor fit and interest. I think it's pretty crucial for you as founders to really only engage with investors that are really likely to invest in you, meaning there's a suitable fit according to the criteria I showed earlier. And also make sure you have enough time in your calendars. It sounds trivial, but making sure you have enough time in your calendar to engage with the investors in the fundraising process, right? So block out a couple of weeks where you actually mostly focused on fundraising, and maybe you have some other co-founders that keep running the business and take care of the daily operations. So you do a little bit of a split in workload there. And it's pretty crucial to really understand, is this investor really interested or just engaged to learn and to hear you pitching, basically, right? So meaning, ask yourself, is this VC familiar with the space? So based on the questions the VC asks, how substantiated are they? And you can pretty easily get a sense of how likely is it that this VC will actually invest in our company or not. And then I would encourage you to ask really early on, can this investor lead the current financing round, or will it be more co-investor and follower, and this might be more passive in offering you a term sheet, whereas a lead investor would probably more aggressively go to lean towards a term sheet decision and will offer you a term sheet, hopefully, eventually. And then also try to get to know as early as possible. The more, I know it hurts quite a bit to be rejected, obviously, but getting to a quick no is way better than just dragging out the process and yeah, giving the VC too much time to engage with you and then to do multiple rounds without moving the process actually further. So really push for an early no, or be pretty clear what the next steps are. And this is my next topic that I will address. But there's a question: how do you deal with the undecisive investors that don't say yes or no? Yeah, pretty good question. And this is where I really encourage founders to really push for it, right? Because what do you have to lose? Basically, a quick no. But you can phrase it in the sense that what are your current reservations, or what are the current process steps that are needed for you to say yes and offer us a term sheet, right? And then the investor is in the position to actually tell you what the reservations are, and or what the process will be to get to that final decision, hopefully to a yes, right? So put it on the side of the investor to tell you, to give you the information, and not just to guess. And based on the answer, I think you will have a pretty good impression if this is like a little bit of a wishy-washy answer, or if this is still part of a clear process and it just takes a little more time for the investor to build that conviction. So hope that shed some light on the question, Thomas. But I'm moving on to the next investor decision-making process. I think this refers to it as well. It's pretty crucial to understand the open questions, the D items that still need to be answered for the VC to move to a positive decision question, right? So sometimes there's just a few questions the VC needs to answer in each process, and it's pretty important for you as founders to understand what those are, and it's pretty legitimate to just openly ask for it. So what's needed to move forward here in the process? What does the internal decision-making process look like? And that's the next aspect. So try to understand if they're an external investment committee at the VC fund, or if the decisions are made within the team. If they are made purely within the team, such as it's the case with us, it's way easier of a process. There's no external communication or alignment needed. What is the cadence of the investment decision-making process? So are there weekly meetings? Is this a monthly meeting? That also varies from VC fund to VC fund. Most independent VC funds have a weekly, at least a weekly, or maybe even twice a week, a decision meeting where those decisions can be made. And who are the respective decision makers at the VC fund? Sometimes the full partnership decides, so every partner has a vote, basically. Sometimes for some funds, it's just one senior partner that has the ultimate vote, and you really need to convince that single person. So really try to understand the dynamics of the VC fund, and again, by asking other founders, angel investors, or other VCs about their assessment of that fund. And you ultimately want to figure out what is the path towards a partner meeting. Usually in a partner meeting or after a partner meeting, a term sheet decision is being made. So meaning a term sheet is issued, which then is the investment decision, the positive feedback for you that the VC fund wants to engage with you and wants to partner with you. All right. Moving on to the next one, investor communication. So what I've learned in the process with numerous founders, the best founders are really able to alternate the speed of communication. And what I mean by that, they're able to move the process pretty fast because they have all the documents, they're prepared, they have time to engage in those conversations, but also they are maybe able to delay at a certain aspect when they want other investors to catch up, or maybe even signal that there's some other investor conversations going on, some other investor interest, and that obviously creates a little bit of FOMO on the investor side. So best founders are able to play a little bit with the speed of the processes, but I would encourage you to not overuse it, because also VCs don't like that when it's too apparent, and if it's like too much of a back and forth game. But yeah, be open with sharing questions or unvalidated hypotheses about your business, specifically in the early stages. It just creates trust with both of you, and it might engage you in a collaborative working session with the investors if you create those, or if you openly post those questions and get the take of the investor on those ones. Yeah, last but not least, be confident, but don't oversell. And in terms of investor relationship building, I experienced it super helpful if founders build strong relationships with a couple of VC funds prior to raising the next round. So meaning, just pick a handful of investors that will be a really good fit. engage with them on a personal level, so meaning in person, on a regular cadence before actually raising, and familiarize them with your company, with your team, the market, and the product. It enables you to learn about their take on the market, your positioning, the competition, and you're able to incorporate this feedback in your pitch deck before you even start raising, right? So it's valuable feedback, and you can receive from investors. And show that you take the feedback seriously. Maybe show them how you incorporated it, how you developed the company, the pitch deck further based on that feedback, because it established a very good relationship with them even before investing. It feels like you're in a good sparring situation even before you have them officially on board. And of course, show existing progress on the product, on the business side while you're engaging, and try to make it personal. Try to set up personal meetings. Hopefully, COVID permits. It's way better than, from my experience, than regular investor update emails, etc. It's just not very personal and engaging. And then eventually tell them ahead of time that you will be start raising your next round soon, and see what happens. And that leads me actually to the next part, and ultimate part of the workshop. It's a little bit of a bonus question, but it happens more and more in today's fundraising environment, is that certain financing rounds are being preempted. But before that, a word on investor FOMO. So FOMO for fear of missing out. So as you know, today's VC market is very heated with compressed fundraising timelines. Why is that? First, because there's more and more capital available to founders, which is very good. And that means on the other side that there's higher competition among investors to partner with the best founders, right? And the second aspect is that because of COVID, there are more and more virtual pitch meetings, so Zoom pitches instead of all the traveling, and that makes the fundraising process less time consuming and more efficient, and speeds up also the fundraising timelines. So it's easier than ever, I would say, for founders to create FOMO. And VCs know that they need to move fast and that there are other funds most likely engaged in the process. So right now, I would say you don't even need to overuse or overly create FOMO in your fundraising process, because it might be natural there already, and you just need to steer the process and keep it efficient from your standpoint. So moving on to the aspect of preemptive funding offer. So what does it mean? That means you get an offer from a VC before you even start your fundraising process, right? So pretty efficient. You don't even need to run a full blown process, and you already have an offer that might be as so good that you actually want to accept it. And from an investor, you would actually really like to partner with and to work with. And I see this happening mostly through two different ways. So one way is through the relationship building I described before, meaning US founders build relationships with a select group of investors, really just a handful, I would say. And then one or two of these investors have built the conviction enough and like your process, like your progress, like the positioning, like you as a team, and then they want to engage and partner with you before you start the fundraising process, so there's less competition for them. Or second way, an investor does a deep dive on a certain industry sector, for example, and really wants to make an investment in that space, and then proactively reaches out to you, engages for a short period of time to learn about the specifics of your business while knowing the space in detail, and then offering you a term sheet proactively. And last bit of advice here, be aware of the terms the investor offers, right? Specifically here also investment amount and equity stake, as there's no process of competing offers. It will be just one or two investors preempting the round. So make sure it's really an offer you want to accept and also an investor you want to have on board. And also a preemptive offer is not really an offer unless there's a term sheet. So whatever the investor says, really aim for receiving a term sheet, or it's not an ultimate offer. So yeah, this would have been the very quick workshop. I think we're also at the end time-wise. Are there any further questions? Otherwise, feel free to reach out to me. You have my contact details here, or add me on LinkedIn. Happy to keep this to take this also offline if you have additional questions. All right. If there are no further questions, then thanks so much for participating. I think there were some good pieces of advice for you can use for your next financing rounds. And yeah, best of luck for your upcoming round. Hope it will be successful. Thanks so much for tuning in. Bye bye.